everyone, I'm Sonali Mehta. I'm here to introduce Ruchika Bhagat. Ruchika Bhagat is a chartered accountant in a figure art Neeraj Bhagat and Company, a prominent chartered accountant accountancy firm in India. With over 27 years of experience, she has established herself as a trusted expert in Ruchika in business advisory, taxation, regulatory compliance, and risk management. A member of Institute of Chartered Accountants in India since 1998. Ruchika's graduate from University of Delhi in 1996, laying a strong academic foundations career here. Her professional journey is marked by a significant contribution to both Indian and international businesses. Specializing in setting up operations for foreign company in India, she ensures compliance with complex regulatory frameworks. Ruchika's expert spans corporate taxation, company formation, and strategy financial planning, marking her of the firm's success. After passing of the firm's founder Neeraj Bhagat in May 2021, she took on a leadership role the organization with the same passion and commitment that defined its 23 years legacy. Ruchika's ability to blend local regulatory knowledge with a global perspective has earned her from the client across industry. Her strategy, insight, and dedication to client satisfaction contribute to inspire her team, Divine, Neeraj Bhagat and Company to new heights. With the focus on innovation and excellence, Ruchika Bhagat remains a key influencer in India financials and corporate landscape. Hello, ma'am.
Thank you, Sonali. Thanks for the nice introduction. In fact, I'm very much thankful to the tax crew for giving me this opportunity. So good afternoon, everyone. I'm CA Ruchika Bhagat, working extensively with NRIs and foreign companies looking to set up their business here in India. So my focus is on taxation, business advisory, and compliances. I regularly appear on news channels, debates, and seminars, and prefer to simplify complex tax-related topics. Hoping to have an interactive session today. Let's start with this NRI taxation webinar. So whether you are NRI yourself or advising someone, I hope that this session will be helpful to simplify the key concepts and compliance requirement. So I'll change. So in this webinar, I'll be discussing who are NRIs, that is how you determine the residential status of NRIs, what income are taxable in the hands of NRIs, what is double taxation avoidance agreement, and how the TDS implications apply on NRI, how they file their ITRs, and last but not least, tax planning with regard to the repatriation and taxation on NRIs. So let's begin with the basics. So exactly who are NRIs and why the taxation is so important for them. So first of all, before we start, we should understand the difference between NRI and non-resident. That is non-resident Indian and non-resident, as Government of India has a different tax provisions for both of them. So what I can say regarding this is that NRI is a special category among the NR. So that is, which means that NR is a broader definition, which includes not only NRI, it also includes Indian citizens, it includes the person of Indian origin who are living outside India. So any person who is a resident of India, but who is residing outside India for any work related or any business related process or any other, for due to any other reason for almost most of the year. That is the key test here is 182 days rule. So if you are staying in India for less than 182 days, you are resident of India. If you are staying in India, staying outside India for more than 182 days, that means you are non-resident. So once this residential status is determined, next step is regarding the tax liability. As the tax liability depends upon the incidence of residential status. What is your exact residential status here in India? So since we are talking about the residential status in India, there are basically three categories of residential status. You will be resident and ordinary resident, resident but not ordinary resident, or you will be non-resident. So to determine whether you are resident and ordinary resident or resident but not ordinary resident, we need to check the basic condition. And what our basic condition says is, again, criteria of 182 days. That is, if you are staying in India for 182 days in previous year, or you are staying in India for 60 days in previous year and 365 days or more in 4 years immediately preceding previous year. So these are the two criteria of the basic condition. If a person satisfies any one of the basic condition, he becomes a resident of India. If he do not satisfy any of the basic condition, then he becomes non-resident. That is as simple as that. But there are exceptions to this rule. So if there is a person who is a resident of India, that is, who is citizen of India, and who is going outside India for any job or for any business, simultaneously, his income from India is up to rupees 15 lakhs. Again, I repeat, you are citizen of India, you are moving out of India because of any job or any business. Your income from India for the entire financial year is up to rupees 15 lakh. In that case, we will only check first condition of basic. That is, stay in India for at least 182 days or more. We will not consider the second point. So if in case any person who is going out of India for business and profession and his income do not exceeds more than 15 lakh, then for him, only first basic condition is need to be checked. Second basic condition is not required. So when we are discussing this thing, this is all about the residential status, that is, you are resident or non-resident. So what about your ROR and RNOR? So for that, we need to check the additional condition. If both the additional conditions are satisfied, your ROR. If one or none of the basic condition is additional condition is satisfied, your RNOR. So this is all about the residential status of individual. What about the residential status of other entities? For example, companies. Well, for them, there is no such basic condition or additional condition. For them, the criteria for determining the residential status is only and only the control and management of the business. So if in case, if any company has management and control of business entirely situated in India, it will be considered as resident of India. It will not be considered as non-resident. But if in case this management control is entirely outside India or partly outside India, then it will be treated as non-resident. So recently, Supreme Court has come up with a judgment in Mansarovar Commercials Private Limited, where Supreme Court has given the definition of the management and control. So according to it, this management and control should not be a theoretical power. It should be the actual power that should be exercised by the directors. That is, if directors are controlling the company from India, then that company will be considered as resident of India, even though it is incorporated outside India. So what about the shareholders? If in any company, 99.9% shareholders are resident of India, but that company is incorporated outside India, whether that company is a resident of India? So answer is no. Residential status of the companies do not depend upon the shareholding. It depends only and only on de facto control and management of business of India in India. So if in case any company is registered in UK and 99.9% shareholders are situated in India, then also that company will be treated as foreign company only. It will not be treated as resident company. Similarly, on the similar lines, if a company has a holding company in India and a subsidiary company in UK, then this subsidiary company, though it is a subsidiary company, but still will be treated as non-resident only. It will not be treated as resident company. So coming to the next important definition, that is deemed resident. So first, let me discuss how we can become a deemed resident. Then I'll tell you why this definition is so important. So the condition for becoming deemed resident is, first of all, you should be an Indian resident. Your Indian income should be more than rupees 15 lakhs. You are not resident anywhere around in any country around the globe, and you are not paying any taxes in any part of the world, in any country of the world. If all these conditions are fulfilled, then you are simply treated as a resident and ordinary resident of India, and you are taxed accordingly. So this amendment was done in Finance Act 2020. So Finance Act 2020 brought this major amendment where they have defined the scope and definition of deemed resident. So what was the need of introducing this section? Well, the reason for introducing this section was to avoid tax evasion. So what was happening was, many of the Indian residents who were billionaires, they were shifting out of India. They were changing their residential status. That is, earlier they were resident. They were changing their residential status from resident to non-resident. And they were shifting to those countries where tax is almost nil. So in that way, if you see, they were evading tax in India, as well as they were not paying tax in that country just because they were getting tax exemptions over there. So in both the ways, they were getting this benefit. To avoid this thing, government has come up with this. For example, supposedly my uncle, he being citizen of India, he moved from India to Dubai. He has more than 15 lakh income from India. And since he has shifted to Dubai, their tax on income is nil. So in this case, my uncle can be treated as deemed resident, and he will be resident but not ordinary resident of India and has to pay tax accordingly. So I'll shift. So when we are talking about the tax liability of non-resident, so we need to consider what are the exact source of income. That is, it is received or deemed to received in India, or it accrues or deemed to accrue or arise from India. These are the major point of conflict at the time of computing the taxation of the non-resident. So let us discuss each of these items one by one, starting from what is deemed to be received in India. So any income that is deemed to be received in India, it refers to a legal fiction where a certain type of income, they are treated as if they are received in India, even though they have not actually been received in India. That is, this concept enshrined in the tax law. It ensures the equitable taxation. That is, it prevents the tax evasion by the taxpayers for deferring the income recognition. So any income deemed to be received in India, it refers to any income which is considered to have been received by the taxpayer, even though it has not been physically received in cash or in any other equivalent form. It is only deemed to be received. So when we say deemed to be received, so any income that is deemed to be received in India is taxable in the hands of non-resident. For example, if you have accrued any interest, so that is yet to receive, has not been received, but still it will be considered as deemed to be received and will be taxable in the hands of non-resident. Similarly, if you have received any payment in advance against any professional services or against sale of goods or material, again, this advance payment will be treated as deemed to be received in India and will be taxable. Similarly, if you have any dividend, accrued dividend income or unrealized revenue, all of these incomes will be treated as deemed to be received in India and will be taxable in the hands of non-resident. So next come the another definition, that is deemed to accrue or arise from India. So when we say deemed to accrue or arise in India, you see there are two basic components. That is, one is accrual and one is receipt. So income is taxed in any country based on these factors, that is accrual as well as receipt. whether it is accrued there or it is received there. So earlier there was a gray area whether income should be taxable on the basis of accrued basis or it is taxable on receipt basis. So to avoid this conflict, Indian government has amended Section 9 and has categorized 7 incomes for the non-resident, which Indian government considered as deemed to accrue or arise in India. And if any one of these income is being arise from India, then it will be considered as deemed to accrue or arise from India and will be taxable in India. So let us discuss all these 7 categories one by one. To begin with, government has described the business connections. So any transaction that has a business connections from India will be taxable in India. So when I say business connections, it means that it is connected to any business in India. If you are making any stock of goods or making any delivery from India, or you are securing order from India, in that case, it will be taxable here in India only. Similarly, if you have any property in India, and that property is being sold, that is, you have any assets or any house property, and you are selling off that property. Since this property is situated in India, so any sale of this property will be taxable in India only. Any capital gains that is arising from that income, not only sale, which is related to capital gain, but if any other income is also arising from that income, that property, that is also taxable in India. So when we say this business connection, it includes in case if you are hiring any agents for doing any business, that is also part and parcel of business connections. But we have been having a lot of cases for this section. And if in case any independent agent is hired to do any transaction, then such independent agent will not be treated as part of business connection, and any income arising from that transaction will not be taxable. Similarly, if I have hired, I being non-resident, I have hired any agent who is just procuring goods for the export. He is not doing any other transaction. He is just procuring goods on my behalf for the export. Then such agent, any commission that is being paid to such agent or any transaction that is held by such agent, it will not be part and parcel of business connections. Similarly, if a person is non-resident, he is getting any salary from India, then such salary that is being received outside India is taxable in India because it is considered as deemed to accrue or arise in India. On the similar lines, if I was residing in India, now after leaving my job, I have shifted outside India. Supposingly, I have shifted to US. Now I am getting pension from India. So this pension is arising from India, though it is being received in my US bank account. Is this pension taxable? So answer is yes. If you are getting this pension is taxable. Similarly, if I am a diplomat that is being hired by Government of India, I'm working as a diplomat in Japan. Obviously, since I am being hired by Indian government, so Indian government is giving me salary from India to Japan. So in this case, even though I'm receiving this salary in Japan, but still this income, salary income will be taxable in India. If in case I'm holding any shares of Indian company, I'm a US resident, I'm holding any shares of US Indian company, and this Indian company is giving me dividend. So in this case, whatsoever dividend I'm receiving in US from this Indian company will also be considered as deemed to accrue or arise from India and will be taxable. Similarly, any technical fees for technical services or any royalty income that I am receiving from India, either I am receiving this royalty income from Government of India or from any Indian company or any person from India. Although the agreement for royalty or FTS has been made outside India, although I am receiving this payment outside India under the agreement that was done outside India, still whatsoever royalty or fees for technical services I am receiving from India will be taxable in India only. As I said, there are a lot of judgments on Section 9 because there was a lot of confusion. Still, there is a lot of confusion regarding determination of income under Section 9. So, the Supreme Court recently also held one judgment regarding this. So if in case any person who is hiring an agent in India, who is just inviting offers, he's not doing any business, he is inviting offers to vendors here in India. In this case, any transaction, any income arising from such transaction will not be taxable in India. Similarly, if you are paying commission outside India on goods exported outside India, which is being exported from India, but is not taxable in India. So one thing more here I want to add, if you are receiving any salary outside India for working for a foreign company, again, you are working for this foreign company outside India. Again, this salary will not be taxable in India. So there is very thin line of definition of deemed to accrue or arise in India. So we need to check the business connections, we need to check the royalty income, we need to check exactly where this income has accrued and arisen. On the basis of this income will be taxable in the hands of non-resident. So taxation of non-resident is almost similar to the resident. So what is the difference between the basic difference between the resident taxation of resident and non-resident? Well, if we see head-wise, so non-residents, whenever they pay tax here in India, the 5 heads that are applicable on resident, that is salary, house property, PGVP, capital gains, and income from other sources, all these 5 heads are applicable to non-resident also. They are same. And normally people have this question, if the NR can get the benefit of basic exemptions? Well, answer is yes. If in case you are non-resident, you are filing return here in India, so you are supposed to get the benefit of the exemptions and deductions. So let me discuss those exemptions and deductions one by one. In case of house property, non-residents are eligible for getting the statutory deduction at the rate of 30%. In case of salary, they are liable to get the deduction, standard deduction. Similarly, if they are doing any business here in India, so any allowable expense that they have incurred here in India to earn the business income, that expense is also allowed as deduction from the business income. Similarly, normally people ask one more question, that is with regard to the Section 80 deductions. Is Section 80 deductions available to non-resident? Again, the answer is yes. So if in case you are non-resident and you have invested in ELSS, you have invested in ULIPs, LIC, you have made any principal repayment of housing loan, or you have paid tuition fees of your children, then you are liable to get the deduction under Section 80C. Similarly, if you have paid for the medical health insurance, in that case, you are eligible for deduction under Section 80D. Similarly, you are also eligible to get the deductions under Section 80G, that is donation to charitable institutions. And non-resident is also liable to get the deduction under Section 80TTA, that is interest on saving bank accounts. So all these deductions are available. So what is not available to non-resident? Well, there are certain deductions and exemptions that are not available to non-resident. For example, if they're investing in PPF or they're investing in post office scheme and NSC, so these deductions are not allowable under ATC. Similarly, if there is a physically handicapped non-resident, he cannot claim the deduction under Section 80U. If you have physically dependent relative, then deduction under 80DD and 80DDP is not available to non-resident. So all these deductions and exemptions are available. Rest all these deductions and exemptions are available to non-resident apart from last deductions. Okay, since we have discussed the tax liability, how we become resident or non-resident, then we have discussed the tax liability, how under which head we can pay the taxes and what are the exemptions and deductions that are available to us. Let us discuss the bank accounts that non-resident can operate here in India and how they can operate these bank accounts and ultimately how they can close these bank accounts. So being non-resident, a non-resident can open NRO, NRE and FCNR account here in India. So any person who is non-resident, any person who is leaving India for any job or profession, or any person who is leaving India for a long time or permanently due to any reason, they may open these accounts here in India, that is NRO, NRE and FCNR account. So starting with each of the bank account, that is first of all NRE account. So when we talk about NRE account, so NRE account is always opened with INR only. So NRE account can be saving bank account, it can be your current account, it can be your FDR account or RD account. So the best part of NRE account is whenever you open NRE account, any interest that you are getting from NRE account is totally exempt, and you can transfer all your income after tax to NRE account. In fact, you can transfer from NRO account to NRE account after getting a CA certificate. So inter-transfer, that is from one NRE account to another NRE account, is also available. So what is the advantage of opening NRE account? Well, if you have NRE account, as I said, first thing, any interest that you are getting in NRE account is fully exempt. You don't have to pay any taxes. Second thing, it is freely repatriable. You can transfer any amount from your NRE account. And third thing is there is no wealth tax on NRE account. Similarly, you can also open NRO account. So when we talk about NRO account, so NRO account is just like a saving bank account. But interest on NRO account is taxable and it is subject to TDS at the rate of 31.2%. We can also do repatriation from NRO account also. But this repatriation has a threshold limit of 1 million USD. You cannot repatriate more than 1 million USD from this NRO account. Similarly, we can have FCNR account. So basically, FCNR account is a FD account which you maintain in foreign currency to avoid yourself to save yourself from any risk of currency fluctuations. And again, the best part of FCNR account is any interest that you are getting from FCNR account, it is totally tax-free. You don't have to pay any taxes on interest received from FDs in FCNR account. And the time limit for the FDs ranges between 1 year to 5 years. So you can keep this amount till the maturity in FCNR account, and later on you can get this, whatever interest you are getting, you don't have to pay any taxes. So do we need to close these accounts? Yes. If in case you are coming back to India with intention of settling down here in India permanently, then you have to close your NRO account and NRE account at the earliest without any delay. FCNR account can be closed as and when your FD gets matured. The liability for closure of the NRO and NRE account is totally on the NRI who is coming back to India. It is not the liability of bank authorities to intimate you that you have to close this account. It is your responsibility. So without any unreasonable delay, you have to close this account. In case if these accounts are carried on without any genuine reasons, then it may attach to penalties and prosecutions. One thing. Second thing is interest that you are getting on NRE account may be liable to tax. So as soon as you are returning back to India with the intention of settling permanently here, you need to close these accounts at the earliest. So coming to the DTA, that is direct tax avoidance agreement, direct taxation avoidance agreement. So as this name suggests that when there is a double taxation, that is individual is liable to pay tax on the same income in more than one country, then only DTA comes into scene. However, DTA is in effect, that is your income should be taxable in both the countries. If you are paying tax in one country, then DTA does not come into the scene. So what benefits you get from DTA? Either you will get a tax exemption or you will get a tax credit under DTA. So DTA agreement, it covers a range of income. That is, it covers income from employment, it covers business income, dividend income, interest income, royalty, and capital gains. And these agreement, it specifies the guidelines as to which country holds the right to impose the taxes on any particular type of these incomes. Typically, the country where the income is generated, that country retains the primary right to levy the taxes. Whereas the country of residency, they may impose also taxes. But ultimately, the best advantage of DTA is that tax rates are at lower rate as compared to the income tax rate. So this is not only advantage that we get from DTA, that is, we are getting the tax benefit with regard to the double taxation. The other advantage that we get from DTA is with regard to the residential status also. So sometimes whenever we apply section 6 to determine the residential status, it happens that a person is considered as resident of more than one country. That is, he is considered as resident of two countries at the same time. So I give you a practical example here. So one of our clients, they approached us. He was basically a Korean person. And he approached us because he was residing in India for more than 182 days. That means he was a resident of India. And he was in India under the contract between his Korean employer and the Indian company. So the question here was arising was whether the salary that he is receiving in Korea, that would be taxable in India, since he is meeting the residential status of both the countries. That means he has to face the double taxation. Well, in such a condition, we refer to DTA, and ultimately DTA helped in avoiding the double taxation by offering rules for the tax relief. So Article 4 of DTA between India and Korea, it specified that if a person is resident in both the countries, then the country which has a permanent home, that is natural habitat, that can be only treated, that country can only be treated as actual residency of that person. So in this case, since he was from Korea and his actual habitat was in Korea only. So even though as per section 6, he was being considered as resident in both the countries, that is India as well as in Korea, but because of taking the benefits under DTA, he was considered as a resident of Korea only, and therefore he was able to avoid double taxation under the benefits of DTA. So in short, while determining someone's residential status and taxable income, we should consider the provisions of DTA along with section 5 and section 6 of income tax. So just now, as we discussed, that DTA with other nation, it offers provide reduced tax rate or exemptions on income, such as dividend, interest, royalty. So normally, to get the benefit from the lower tax or exemptions under DTA, the taxpayer, first of all, he has to file ITR here in India. Secondly, he also have to submit specific documents like TRC, 10F, and no PE to Indian government so that he can claim the benefit of DTA. In case he is not submitting these documents, then he is supposed to pay taxes at the higher rate. For example, if I am a non-resident of Hong Kong and I am getting any dividend from Indian company. So whatsoever dividend I am getting in Hong Kong from Indian company, as per DTA between India and Hong Kong, tax is only 5%. So only 5% TDS will be deducted on my dividend income, which I am getting from India, provided I need to submit Form 10F and TRC to Indian government. So what exactly is Form 10F? Well, Form 10F is a self-declaration form that is used by a non-resident taxpayer for claiming the benefits of DTA. And what is TRC? TRC is basically a document which is issued by the government, that is taxation department of a country where the person is tax resident. That is, a person tax residency status depends upon the location from where they perform their services or obtain their income. So therefore, any NRI, he has to submit the TRC to the government of the host country. That is where exactly he is getting this income. And this TRC is issued by the government of his home country. That is where actually he is residing. Similarly, a lot of companies also have to submit a NOP, that is no permanent establishment certificate, also to the host country from where they are getting the income. So till now, we are very much clear that if you have any property in India, you being non-resident, if you are disposing of that property or any asset that you held in India, so whenever you dispose of such property or asset in India, you are supposed to pay taxes under the head capital gains. So sale of this capital asset is subject to long-term or short-term depending upon the period of holding of that asset, capital asset. You being non-resident, if you are non-resident, you are not going to get the benefit of indexation in India. And in LTCG, the tax flat rate is 12.5%. And for short term, the tax rate is 30% of the capital gains at the time of filing your ITR. But whenever you sell off this asset, whenever you dispose of this asset, at that time, according to the provisions of income tax, the buyer has to deduct TDS. If in case it is long-term capital gain, then it will be 12.5% of the sale price of whatsoever asset you are selling. So if you see, TDS is deducted at sale on sale price, that is 12.5% of sale price. And while paying taxes at the time of filing of ITR, you pay tax on capital gains. So initially, if you see, lot of tax is deducted just because of this. To avoid this deduction of tax at the initial stage, any non-resident can apply for LDC, that is lower deduction certificate. So whenever you are non-resident, whenever you are selling any property here in India or any capital asset in India, you may apply for lower deduction certificate so that to avoid your TDS at higher rates. If in case you think you have your capital gains will be less, you will be paying less rate of tax ultimately at the time of filing of your return. So what if that you are selling any property or you are selling any capital asset? Can you get the deductions or exemption under Section 54? Well, yes. Before that, let me share this, that if you are selling any long-term capital asset, then you are not going to get any deduction benefit of indexation in India. You are only going to get the benefit of first proviso to Section 48, that is conversion. So even that is also beneficial for non-resident because it is related to the currency fluctuations, but benefit of indexation will not be available. Only first proviso to Section 48 will be available for conversion. So while next talking about the exemption part, that is non-resident eligible for getting exemption under Section 54? Answer is yes. So whenever you are selling any property and you buy any other property within 1 year before or 2 years after or 3 years in case of construction, you are liable to get benefit of Section 54. Similarly, if you are selling any asset, long-term asset, and within 6 months you purchase any NHAI bonds or Rural Electrification Corporation bonds up to rupees 50 lakhs, again you can get the benefit of Section 54 EC. And last but not least, if you are selling any long-term asset and in return you are purchasing any property, then deduction under Section 54F is also available to non-residents. So if you see, in total, non-residents are at par to resident only while paying taxes here in India. Similarly, if you have any property and you have let out that property in India, as we have already discussed, that is income deemed to be received from India. Therefore, it is taxable in the hands of non-resident. So in this case, if you are letting out any property here in India, it will be taxable in India, as I said, and TDS at the rate of 30% will be deducted on such income. So whenever you will be repatriating this amount outside India, you need to file 15 CA and CB to bank authorities. So just now we discussed Form 15 CA and 15 CB. So what is basically Form 15 CA and 15 CB? Well, Form 15 CA and CB, they play a crucial role in the repatriation of fund from India to any foreign country, especially for NRIs and foreign entities. So these forms are mandatory by the Indian Income Tax Authority, and they are essential to ensure that tax compliances before remitting the money has been fully compliant. So whenever there is any repatriation of rental income, interest, dividend income, or sale of property, or if there is any gift or inheritance, or you are transferring any amount from NRO to NRE account, we always need to have Form 15 CA and 15 CB. So what is basically Form 15 CA? Well, 15 CA is an online declaration that is submitted by a person who is making this remittance. So it serves as a mechanism for the tax department to track a foreign remittances and assess whether the tax has been deducted properly or not. So we can file this 15 CA online also, that is on income tax e-filing portal. It contains all the details of remitter, it contains the details of remittee, it contains the details of nature of the payment, whether tax has been deducted on it or not. Similarly, this 15 CA is divided into 4 segments, that is part A to D, and part D is depending upon that non-taxable remittance. And part A to C is basically with regard to the other taxable remittances. Similarly, coming to Form 15 CB. So Form 15 CB is basically a certificate by a chartered accountant which verifies the nature of the remittance. It verifies whether the tax provisions as per income tax or as per DTA has been duly applied or not. If you see, Form 15 CB is mandatory remittance whenever there is remittance of more than rupees 5 lakh. It is also required for filing Part C of Form 15 CA. So whenever you are going to file Part C of Form 15 CA, you need to have 15 CB from your CA. So when 15 CB is not required, when it is not required, whenever you are making any remittances in the form of gift, whenever you are making any remittances in form of scholarship, whenever any remittance that you are making is less than rupees 5 lakhs. So in all these cases, we do not require 15 CB. So now the question arises, why these forms are so important for repatriation? Well, first of all, they ensure that tax on income that is being repatriated has been duly paid or it was not applicable. Secondly, the bank will never process any remittances from NRO without these forms. So you have to make sure whenever you are making any remittances from NRO account, you need to have these forms in place before making such remittances. It helps the income tax department to monitor all cross-border transactions and to prevent the tax evasions. And ultimately, the filing of these forms, it protects the remitter from the tax scrutinies and penalties. So that if in case you have any tax scrutiny, anytime you can prove the payment that is remittance outside India through these forms. So since we have discussed about the income, what income are taxable in for non-resident in India, how they are taxable for non-resident in India. So let us discuss about ITR filing also. So filing ITR in India, first of all, NRI has to calculate his total income under the different heads. That is, he has to take the total income from salary, house property, PGBP, capital gains, and other sources. When he will be calculating this total income, he has to exclude any interest that he has received from NRE account or FCNR account because that is totally exempt in his hands. Similarly, any income that is totally exempt apart from interest on NRE and FCNR account, For example, agriculture income. So again, that exempted income is also to be excluded in the hands of non-resident. And ultimately, if the final amount or the final income amount exceeds the maximum amount not chargeable to tax, then non-resident is supposed to file ITR here in India and to pay taxes. But it do happens that at times they are not having income which is maximum amount not chargeable to tax. That is, they have income below the maximum amount not chargeable to tax. But still, NRIs are also liable to pay to file ITR in India if in case they have deposited more than 1 crore in their current account. So even though you do not have taxable income, for example, your total income under the 5 head is just rupees 2,20,000, assuming. In this case, you are not supposed to file any ITR, you are not supposed to pay any taxes. But if in case you have deposited rupee 1 crore in your current account in India, then in that case, even though you are not having taxable amount, still you have to file your ITR. Similarly, if you have incurred any expense on your traveling for rupees 2 lakh or more from your Indian bank account, then also you are supposed to file ITR here in India. If your gross receipts or your turnover from the business that you are doing in India exceeds 60 lakhs, or in case if you are doing any profession in India, then the gross receipts from that profession exceeds 10 lakh, then again, even though you don't have a taxable income, but still you have to file ITR in India. In case if your TDS amount exceeds more than rupees 25,000, then also again you have to file ITR in India. And if in case your deposits, you have deposited 50 lakhs or more in your saving bank account in India, then in that case also you have to file your ITR in India, even though you don't have the taxable income. So if a senior citizen or super senior citizen is a resident of India, we all know their basic exemption limit under old tax regime is rupees 3 lakh and 5 lakh respectively. But however, if a senior or super senior citizen is non-resident, then the basic exemption limit remains at rupees 2,50,000 only for the entire financial year, irrespective of their age. So here, senior citizens and super senior citizens, they do not get the exemption limit of 5 lakh and 3 lakh. So the question also arises here, what are the advantages of filing ITR for non-resident in India? Well, they do have the advantages. So as I said, in case of capital gains, especially in long-term capital gains, the TDS is always deducted on sale value. But actually, at the time of filing of ITR, you have to pay taxes on capital gains. So there's a difference between the TDS on sale value and capital gains. So if in case you have any refund, then you need to file your ITR here in India, even though you don't have a taxable income. Similarly, if you want to carry forward the losses for future years and you want to get them set off against the future year income, you need to file ITR here in India. If you want to maintain your status of non-resident, because at the time of filing of ITR, you need to opt for the residential status. So there you have to write non-resident. So if in case you want to continue with your status of non-resident, then you have to file ITR here in India. Or if you want to claim exemptions or special rate of taxes under DTA, even if you're not supposed to pay tax, but still you have to file your return in India. If in case you do not file your return in India, then Income Tax Department may serve you a notice under Section 148. That is, this notice can be served up to 4 years if your taxable income that you have avoided is up to rupees 50 lakhs. In case the taxable income that you have avoided is more than 50 lakhs, then in that case, the time limit is 6 years. That is, up till 6 years, Income Tax Department can serve you a notice. So we have already discussed DTA. That is, we have discussed one part of DTA where we have discussed about the residential status, how DTA helps you in determining the residential status. Then we also discussed how DTA helps in determining the lower rate of taxes. That is, we compare tax rates under DTA and tax as per the income tax rate, whichever is beneficial to the assessee. Assessee always pay those taxes subject to certain conditions. Now we are going to have another advantage of DTA. So if in case, let's start with an example first. Assuming Mr. A, who is resident of UK, he is earning income from UK, but simultaneously he is also holding certain shares in Indian company. And because he is holding certain shares in Indian company, he is getting dividend from India. So if you see in this case, while paying taxes in UK, he has to pay tax on UK income along with the dividend income, because that is a resident country. Secondly, since India being a source country, source of income country, therefore he has to pay taxes on dividend income in India also. So in this case, if you say same income of same person is being taxed twice. So to get benefit of paying taxes in one country, or to get benefit of tax credit of whatever tax has been paid in another country, we can claim the tax relief under section 90, 90A and section 91. So let us discuss all these three sections one by one, starting with section 90. As the name suggests, double taxation relief. That is, the section 90 basically provides bilateral relief. Whenever Indian government has an agreement with the government of the country where the income is earned and taxed, in such cases, we are covered under section 90. So Indian government has DTA with over 94 countries in the world. So what is the relief under this section? Well, since the Indian government is having agreement with the government of the other country, therefore in this case we can get the relief in two ways. One, it can be exemption method, that is, assessee is liable to pay tax only in one country, he won't be paying tax in the other country. Secondly, he may get the tax benefit on the basis of credit, that is tax credit method. So it means he will be paying taxes in both the countries, but he will get the tax credit in the tax of in his home country. For example, if Mr. A, he is non-resident and he has an income from India. Supposedly he has 2 lakh income from India, and simultaneously in his home country, that is assuming his home country is US. So he is earning income of rupees 3 lakh. In total, he is earning 5 lakh rupees. If in case India has a double taxation agreement with US, which India has, so in this case, in this person, Mr. A, can get benefit in either of the two way. Either he will be paying taxes altogether in his home country on rupees 5 lakh. He will not be paying any taxes in India. One thing. Second thing, he may have to pay taxes in both India as well as UK, US. But ultimately, whatsoever taxes he has paid in India, he will get the tax credit in US at the time of filing of his return. So this is how bilateral relief works. Coming to the next section, that is section 90A. Well, section 90A also relates to the bilateral relief only, but it is very much different from section 90. Whereas section 90 has, in section 90, there is an agreement of Indian government with the government of the other country. Whereas in section 90A, there is an agreement between two entities from two different countries. That is, it is in sharp contrast with section 90, where the DTA signed by, where there is DTA signed by two governments. So here, DTA is signed by two entities, not government, from two different countries. For example, if I am working in India, and supposingly my company has a subsidiary in UK also, and my company and this UK subsidiary has a bilateral agreement under section 90A. So in this case, if I am promoted to UK or I am shifted to UK and I am getting salary there also, to avoid double taxation in India and UK, I will get a tax credit. So in this case, the difference again lies is in case of double taxation, bilateral relief under Section 90, you may get the tax exemption, but in this case, you will only get the exemption through tax credit. So I can get a foreign tax credit. So whatsoever tax has been paid in UK, if I am citizen of India. Similarly, next comes Section 91, that is unilateral relief. So what if the Indian government do not have any agreement with the government of the other country where I have earned the income? So in this case, to get a relief from this double taxation, foreign tax credit is available. And normally it is limited to the lower tax rate among the two countries. For example, if I am a US citizen, I'm earning income from India. Supposedly, let's say I'm earning 2 lakh rupees from India. And in India, I'm supposed to pay tax at the rate of 30% on such income. Whereas in US, I'm supposed to pay tax at the rate of 40% on this income. So under Section 91, I'll be getting relief at the rate of 30%. That is whichever is least, 30 or 40%. So anyhow, if you are paying double taxation, if you see, you are going to get relief either under Section 90 if the government has agreement with the other government, or 90A if your entity has agreement with the other entity in different country, or Section 91 there is no such agreement, but still you get the tax benefit under tax credit method. So we also have some special rates of income for non-residents. So Indian government has Chapter 21A, where Indian government has specified certain incomes and Indian government has specified the tax on that income. So in that case, if you are covered under Chapter 21A, which is entirely optional, so if you are covered under Chapter 21A, you will be paying tax at the rate whatsoever is mentioned in the relevant section of Chapter 21A, depending upon the type of income that you are earning. So I'm not discussing entire Chapter 21A. I'll be discussing the important sections only. So to begin with, first of all, if in case you are earning any income from foreign exchange assets, what is mean by foreign exchange assets? So if you have purchased any assets, for example, you have purchased any shares of Indian company in foreign currency, you have purchased any debentures of any public company, bonds of any public company, or you have purchased any securities of Indian government, you being non-resident, then whatsoever interest and dividend you are getting is taxable at the rate of 20% flat. So no deduction will be available from this income. Flat, it is 20%. And in case if you sell off these assets, then long-term capital at the rate of 12.5% will be charged to tax. So what about other income? If you are getting any other income from these assets, well, if you are getting any other income from these assets, then it will be chargeable to tax as per the normal provisions. No benefit of indexation will be given. Only first provision to Section 48 will be applicable. So since this section is very much optional, why I should opt for this section? Well, if you see, here it is written that dividend and interest is taxable at the rate of 20%. Supposingly, whatsoever amount of dividend and interest I am getting, if I'm not covered under this section, I'm supposed to pay tax at the rate of 40%, or maybe I'm taxable at higher slab rate, that is 30% plus. Then it is better to pay tax under this section rather than going under the normal provisions. Another benefit that you are going to get is that you are not supposed to file any ITR in India. That is, if you are non-resident, you are getting income only from LTCG, dividend and interest income on assets that you have purchased in foreign currency, then you are not supposed to file any income tax in India, income tax return in India. And last but not least, if in case you sell off these foreign exchange assets and again you purchase any other foreign exchange asset within 6 months, then whatsoever capital gains earlier you were having or earning, then that capital gains will be exempt. So you need to check in which section you are more beneficial, under the normal provisions or under the special provision. So if in case you are more advantageous in special provisions, I'll always suggest to get covered under the special provisions. I'll discuss more about this later on in my next slide. Similarly, not about this, we have more provisions regarding this. So again, if you are a non-resident or a foreign company and you are earning any interest on infrastructure debt fund, then this interest is taxable at the rate of flat 5%. Similarly, if you have purchased any foreign currency loan or you have given any bond, purchased any long-term bonds or rupee denominated bonds, then whatsoever interest you are getting, flat 5% is taxable in India. If you are getting any interest or dividend from business trust, in this case, interest is taxable at the rate of 5%, bonds are taxable, dividend are taxable at the rate of 10%. Last but not least, if you have given any loan to Government of India or to any company here in India in foreign currency, then whatsoever interest you are getting, it is taxable at the rate of 20% flat, provided you are covered under this section. Apart from this, if any non-resident is getting any royalty income or fees for technical services from India, then it is flat tax at the rate of 20%. So when we say flat tax, so whatsoever income is there, you have to pay tax on that income without deducting any expenses from that income. So again, the benefit of being covered under this section, as I said, if you are chargeable to tax at the higher slabs, then it is better to be taxable here only because tax rates are less. One. Second, again, if you have income from these sources only, and that is related to interest dividend only, then you are not supposed to pay any, you are not supposed to file any ITR in India, provided your TDS has been deducted. So when I say royalty income or FTS, what is royalty income or FTS? So if you are getting any management consultancy, managerial consultancy, or technical consultancy, that will be considered as FTS. Similarly, if you are getting any income from the rights of patents, inventions, models, designs, or any similar nature, then it will be considered as royalty income. So there was a case of, famous case, in fact, of GoDaddy.com. So we all know GoDaddy is a portal basically which facilitates the sale of domains. So these domains are in the name of company called ICANN. At GoDaddy portal, we normally go and we purchase the domain name. So any commission that is being paid to GoDaddy for purchase of domain name, is it count for royalty income? The Supreme Court held, no, that is not a royalty income. Royalty income is if you own any patent right, you own any invention, you own any designs or models, and then you are giving it to someone else for use. That will be treated as royalty income. But if you are getting any commission on sales, then it will not be considered as royalty income. So almost we are on the last leg of this webinar. We have discussed how you will be determined as non-resident, what income are taxable in the hands of non-resident, what are the special incomes that are taxable in the hands of non-resident at a special rate, how you can claim the benefit of DTA, whether it is with regard to your residential status, whether it is regard to your taxation, whether it is regard to your double taxation, that is you have to pay tax on in one country, or if you are paying taxes in both the countries, then you will get the credit in any one of the country. And last but not least, how you will pay taxes here in India, how you can compute your taxes here in India. So what are the tax plannings? So let me discuss the tax plannings if in case you intend to return to India. So whenever any non-resident plans to return to India, they should look to the FEMA as well as income tax rules. Why I'm saying so? Because income tax rules, they decide the residential status. So for residential status, we always have to check our income tax. Whereas whenever repatriation part is considered, so that is governed by the FEMA. So first thing, whenever we are planning to move back to India, permanently or temporary, whatsoever the case is. So this decision should be based on the provisions of FEMA as well as income tax. So let's discuss the points that we should always consider if we have such plans of coming back to India. First of all, whenever you are returning to India, so obviously your status was non-resident. So whenever you come to India, we come back to the India. In the initial year, you are always resident but not ordinary resident, and later on your status changes to resident and ordinary resident. So you need to always check what incomes are taxable to RNOR and what incomes are taxable in the hands of ROR, so that you can plan your tax planning accordingly. Similarly, whenever you are planning to sell any property, that is, you are planning to sell your property, you are planning to sell your ESOPs, your investments, whatsoever, whether they are located in India or they are located outside. So that decision is very important when you have to sell, whether you have to sell these assets when you are non-resident or you have to sell these assets when you become resident. So a lot more depend upon the tax rates of your home country, where exactly you are, and the tax rates in India. So considering these tax rates, you should make the decision of selling the assets, that is before coming to India or after coming to India. Similarly, you should plan your retirement plans also accordingly. That is where you have to invest for your retirement plan. Is it the right time to invest in retirement plan before coming to India or after coming to India? Simultaneously, you also need to check your medical or insurance policies. That is whether these medical and insurance policies are applicable in India also or not, and what is the cooling period. You need to check all these things. As I have already discussed this, when you are non-resident, you can repatriate up to 1 million USD from your NRO account. But once you become resident of India, in that case, under LRS, you can repatriate only up to rupees 2,50,000 USD, which is almost 1/4. So repatriation part also need to be considered when you have to repatriate, in case if you have to do repatriation. Is it that at the time when you are residing outside India, or is it when you become resident of India? Similarly, whatsoever funds you have brought into India, where exactly they will be used, that is very important, because as in when you enter into India, you have to close your NRO and NRE account. Even though the FCNR account, it continues till your FD gets matured. So where you have to put in your amount so that you can earn tax-free interest, that is very important. As I said, that as in when you will be shifting back to India, you have to close your NRO and NRE account. So exactly which account you should open? Well, there is an option of RFC account, that is resident foreign currency account. So you can open resident foreign currency account in India. Again, any interest that you are getting from RFC is totally tax-free. And there is no restriction on remittance from RFC account. That is, you can remit any amount outside India from this account. So you have to make this decision at the time of entering into India. That is at the time when you are becoming the resident of India. And last but not least, as just now we have discussed regarding the foreign exchange assets. So if in case I was when non-resident and I was opting for the special rate of taxes, then there we have an option. Even after becoming resident of India, we can still be covered under the provisions of Chapter 21A of Income Tax Act. But before filing of ITR, we need to give a declaration to Government of India whether you want to continue to be covered under those chapters or not. Once you give this declaration, then only you will be covered under the provisions of Chapter 20A, and you will be subject to tax at the special rates that section under Chapter 21A has mentioned. Otherwise, you will be taxable on the income as per the normal resident Indian. So all these decisions need to be taken prior, before you enter into India. So our partners in acceleration are PK Chopra and Company, Elite India, Then payroll, Brooks Payroll Services, Brooks Consultancy Private Limited. And hoping that this webinar is informative for you.